What if I told you that the first devastating financial crash in history wasn't caused by stocks, bonds, or real estate, but by a flower? A single tulip bulb. Sound crazy? Do you think it's impossible for something so harmless to bring an economy to its knees, ruin families, and challenge the very foundations of early capitalism? And yet, it did. And the scariest part is that the psychological and economic forces that inflated this bubble nearly 400 years ago, are the exact same ones we see at play today. What you are about to hear isn't just a history lesson. It's a warning. To understand how a flower could become more valuable than gold, we have to go back to the Netherlands in the early 1600s. This wasn't just any country. This was the Dutch Golden Age. Amsterdam was the financial center of the world, a crucible of wealth, innovation, and ambition. Thanks to their dominance of global sea trade, a new class of merchants and citizens had become fantastically rich. Into this climate of unprecedented prosperity came a new, exotic luxury good from the Ottoman Empire, the tulip. But not just any tulip. A virus, completely unknown at the time, would cause breaks in the petal's color, creating unique, unrepeatable streaks and flame-like patterns. These rare and beautiful varieties became the ultimate status symbol. To own them was to be at the pinnacle of society. Names like the Viceroy or the legendary Semper Augustus were whispered in awe. At first, it was a hobby for wealthy botanists. But soon, people realized something: the price of these rare bulbs only ever went up. And when something's price only goes up, it attracts a new kind of interest. Not from collectors, but from speculators. Tulip fever began to infect not just the elite, but artisans, shopkeepers, even maids and farmers. Everyone saw their neighbors getting rich and wanted a piece of the pie. Demand quickly outstripped supply, especially since it takes years for a tulip bulb to grow and flower. This imbalance created the perfect conditions for a financial innovation that was as brilliant as it was dangerous: futures contracts. Instead of buying and selling physical bulbs, which were only available at certain times of the year, people began trading in the rights to the bulbs. They would sign contracts to buy a bulb at a fixed price on a future date. This changed everything. You no longer needed to be a gardener or own land. All you needed was a piece of paper and the belief that when the contract came due, the bulb's price would be higher. The market, once confined to official exchanges, moved into taverns, into unregulated colleges where anyone could place a bet. People were buying and selling contracts on bulbs they had never seen, bulbs that might not even exist. Between 1634 and 1637, the situation spiraled into a full-blown mania. Prices exploded to unimaginable levels. A single bulb of the Semper Augustus could be traded for a luxurious townhouse on an Amsterdam canal. Period records tell of incredible trades. One Viceroy bulb was reportedly purchased for 2 loads of wheat, 4 of rye, 4 fat oxen, 8 pigs, 12 sheep, 2 barrels of wine, 4 of beer, a ton of butter, 1,000 pounds of cheese, a bed, a suit of clothes, and a silver goblet. To put that in perspective, at the peak of the bubble, a single bulb could cost 2,500 guilders. The average skilled laborer's annual income was about 150. People sold their homes, their land, their family heirlooms, everything, to get into a game that seemed like it could never end. Anyone who questioned the logic of these prices was mocked as a fool who just didn't understand the new economy of flowers. But by their very nature, bubbles cannot inflate forever. They need a constant supply of new buyers willing to pay ever higher prices. And in February of 1637, that supply ran out. The breaking point came in the city of Haarlem. During a routine auction, the unthinkable happened. For a lot of bulbs, at a high but not unheard of price, simply, no one placed a bid. That silence was deafening. For the first time, a crack had appeared in the collective faith that prices could only go up. The news spread like wildfire. If no one was buying in Haarlem, why would they in Amsterdam? Or Rotterdam? The thought that was once heresy suddenly became a terrifying certainty. what if the real price of these bulbs is 0? The panic selling began. Everyone desperately tried to sell their contracts and their bulbs, but there were no buyers left. Within weeks, prices had collapsed by 99%. A bulb that was worth 5,000 guilders was now not even worth the price of an onion. The consequences were catastrophic. Thousands of people, from wealthy merchants to humble craftsmen, were ruined. Many were left holding contracts that legally bound them to buy bulbs at 100 times their new market value. Others had sold everything they owned for bulbs that were now worthless. Trust, the glue that holds any economic system together, had shattered. The Dutch economy, the most powerful in the world, suffered a severe blow from which it would take years to recover. The government and the florists' guilds tried desperately to contain the disaster. They proposed solutions, like allowing contract holders to cancel their agreements by paying a small 3.5% penalty. But it was too little, too late. In the end, the Dutch courts made a drastic decision. They declared that the contracts were unenforceable, treating them like gambling debts. This saved many from debtors' prison, but it didn't return their lost savings, and it sealed the market's total collapse. Everyone was left to bear their own losses. There was no bailout coming. This story might seem like a bizarre relic of a bygone era. But is it? Now, replace the word tulips with .com stocks in the late 1990s. Then too, a promising new technology, unrealistic expectations, and easy money led to astronomical valuations for companies with no solid business model. The Nasdaq lost nearly 80% of its value between 2000 and 2002. Now, replace .com stocks with cryptocurrency. A digital asset with a limited supply, huge volatility, and a revolutionary narrative that attracts millions of retail investors driven by FOMO, the fear of missing out. Here too, we've seen nearly identical cycles of euphoria and panic. The underlying technology is different, of course, but human psychology? That never changes. Greed, fear, herd behavior, and the belief that, this time is different. The story of Tulip Mania leaves us with 3 critical lessons we must never forget. 1. Price and value are 2 different things. An asset is worth what someone is willing to pay for it, but when the price becomes completely detached from its intrinsic value, you are in a bubble. 2. Crowd psychology is more powerful than any fundamental analysis. Euphoria and panic are contagious, and they can drive markets and people to behave in completely irrational ways. 3. Financial innovation is a double-edged sword. Futures contracts, like the complex derivatives of 2008 or the decentralized finance of today, can create efficiency, but in untrained hands and unregulated markets, they can also become financial weapons of mass destruction. The question we have to ask ourselves isn't if the next bubble will happen, but where it's inflating right now. History doesn't repeat itself, but it often rhymes. And the tune of Tulip Mania is still echoing today, nearly 400 years later. Be careful you don't get swept away by the music. What do you think? Do you see parallels in any markets today? Let me know in the comments below. And if you want more deep dives that connect history to modern finance, be sure to subscribe and ring the bell for notifications. Now, go watch our video on the 2008 financial crisis to see how these patterns repeated on a global scale. Thanks for watching.